Have you noticed something strange about Wall Street lately? The headlines celebrate new record highs almost every week. Analysts are raising their targets. Investors who stayed on the sidelines are finally rushing back into the market. It feels like nothing can stop this rally. But history teaches us one uncomfortable lesson. The market often looks strongest just before it becomes the most dangerous. Today, we're going beyond the headlines. We're looking at what the biggest institutions are actually saying, why many analysts believe the S&P 500 could still move toward the 8,000 level, and why the same experts are also warning that one unexpected event could trigger a sharp correction. By the end of this video, you'll understand why 2026 may become one of the most important years for investors in the last decade. Let's begin. Only a few years ago, many believed high interest rates would crush stocks. Instead, something remarkable happened. Corporate earnings proved stronger than expected. Inflation gradually cooled. Businesses adapted faster than many economists predicted. And then another powerful force entered the picture: artificial intelligence. This isn't just another technology trend. It has become one of the largest investment cycles in modern history. The world's biggest companies are spending hundreds of billions of dollars building AI infrastructure, data centers, advanced chips, cloud computing networks, and software platforms capable of transforming entire industries. Unlike previous speculative bubbles, much of today's optimism is supported by real spending and real business demand. That's one of the main reasons Wall Street has continued climbing. But here's where things become interesting. The higher the market rises, the smaller the margin for disappointment becomes. When investors expect perfection, even good news can become bad news if it isn't good enough. This is exactly what many institutional investors are watching today. Every quarterly earnings report now carries enormous weight. Every inflation report matters. Every Federal Reserve statement matters. Every geopolitical headline matters. Because when markets become expensive, expectations become fragile. And fragile expectations can create violent volatility. This brings us to one of the biggest questions investors are asking. Is this another bubble? Or is this the beginning of a completely new economic cycle? The answer isn't as simple as yes or no. Many professional analysts argue that today's environment is fundamentally different from previous bubbles. During the dot-com era, investors poured money into companies with little revenue and no profits. Today, much of the market leadership comes from companies generating enormous cash flows, dominant market positions, and rapidly growing earnings. That doesn't mean stocks cannot fall. It simply means the reasons behind today's rally are more grounded in business fundamentals than pure speculation. Still, no bull market lasts forever. Every major rally eventually faces corrections. Sometimes they're small, sometimes they're painful. The real question isn't whether corrections will happen. It's whether investors are prepared when they do. Now let's see what some of Wall Street's biggest institutions are actually saying. Several major investment banks remain optimistic about long-term market performance. Some analysts have projected that the S&P 500 could approach the 8,000 level if earnings continue growing, inflation remains under control, and economic activity stays resilient. Their argument is straightforward. If corporate profits continue increasing while companies become even more productive through artificial intelligence, higher stock valuations may still be justified. But optimism isn't universal. Other institutions have issued a different warning, not because they expect an immediate crash, but because they believe investor expectations have become extremely elevated. When expectations rise too high, markets become much more sensitive to surprises. A weaker than expected earnings season, unexpected inflation, a delay in interest rate cuts, political uncertainty, global conflicts. Any one of these events could temporarily shake investor confidence. This explains why experienced investors are becoming increasingly selective. Instead of buying everything, they're focusing on companies with durable competitive advantages, consistent cash flow, manageable debt, and realistic valuations. In other words, quality matters more than excitement. This shift is one of the biggest differences between professional investors and emotional investors. When markets become euphoric, beginners often chase whatever has already gone up the most. Professionals ask a different question. What happens if I'm wrong? That simple question changes everything. Risk management becomes more important than predicting tomorrow's headlines. Because nobody consistently predicts every market move, not even Wall Street. What separates successful investors isn't perfect forecasting, it's surviving uncertainty. So how are experienced investors positioning themselves during 2026? First, diversification remains one of their strongest tools. Artificial intelligence may continue driving growth, but concentrating an entire portfolio into one theme creates unnecessary risk. Many institutional portfolios continue balancing technology exposure with sectors like healthcare, industrials, energy, financials, and infrastructure. Why? Because leadership changes. Every cycle creates new winners. Second, liquidity has become incredibly valuable. Holding some cash may feel frustrating while markets rise, but corrections create opportunities. When fear suddenly takes over, investors with available capital can purchase strong businesses at significantly lower prices. Cash isn't always a drag. Sometimes it's optionality. Third, investors are watching economic data more closely than ever. Employment numbers, consumer spending, inflation, manufacturing activity, corporate earnings. These indicators provide clues about whether economic momentum remains healthy or begins slowing. Markets don't react only to today's economy. They react to expectations about tomorrow. That's why understanding trends often matters more than following headlines. There's another psychological factor almost nobody discusses: fear of missing out. As markets reach new highs, many investors suddenly feel pressured to invest because everyone else appears to be making money. History shows this emotion has destroyed more portfolios than recessions. Buying simply because prices are rising isn't a strategy. It's a reaction. Successful investing requires discipline precisely when emotions become strongest. And this may become the defining challenge of 2026. Balancing optimism with caution. Recognizing opportunity without ignoring risk. Believing in long-term growth while preparing for short-term volatility. Because both can exist at the same time. Perhaps the biggest mistake investors make is believing every market correction means disaster. Corrections are normal. Healthy markets breathe, they advance, they pull back, they recover. Long-term wealth isn't built by avoiding every decline. It's built by staying invested through uncertainty while managing risk intelligently. As we move through the second half of 2026, investors face one of the most fascinating environments in years. Artificial intelligence continues reshaping entire industries. Corporate earnings remain the foundation supporting valuations. Central banks continue influencing financial conditions. Global politics adds uncertainty, and expectations remain exceptionally high. Will the S&P 500 eventually reach 8,000? It's certainly possible. Will volatility disappear? Almost certainly not. That's why the smartest investors aren't asking whether the market will move up tomorrow. They're asking whether their portfolio can survive whatever tomorrow brings. Because investing has never been about predicting the future with certainty. It's about preparing for multiple possible futures. The investors who succeed over decades aren't always the smartest. They're usually the most disciplined. They control risk. They avoid emotional decisions. They think in years instead of days. And they understand that markets reward patience far more often than prediction. So before you make your next investment decision, ask yourself one question. Are you investing based on a carefully planned strategy, or are you simply reacting to the latest headline? The answer to that question could determine your results for years to come. If you enjoyed this analysis and want more deep insights into Wall Street, global markets, Bitcoin, and the biggest investment trends shaping the future, make sure to subscribe and turn on notifications so you don't miss the next episode. Now, I want to hear from you. Do you believe the S&P 500 will reach the 8,000 level before the end of 2026? Or do you think a major correction comes first? Share your opinion in the comments. The discussion starts there.